welcome to the second class of financial accounting and reporting. So it sounds like far, financial accounting and reporting, but we at Miles will make sure it's not too far. By the time you complete far, we'll make sure you knock off the concepts on financial accounting, that's your journals, your ledgers, and financial reporting. So when you get out your financial statements and the notes to the financials. So remember the 5 basic financial statements. You have the balance sheet, income statement, statement of comprehensive income, statement of stockholders' equity, and the statement of cash flows. So we learned about all of that in FAR 1. Now in FAR 2, we're going to get into details now. So I gave you the balance sheet back in FAR 1. So the balance sheet looked like this. You had your balance sheet which had assets and liabilities and equity. And we also looked at the income statement. So income statement was sales less COGS. This gives you gross. And then you had less SG&A, gives you operating income. And then we had our mnemonic, on tide, no C. So operating income plus non-operating income less taxes gives you income from continuing operations. Then you had discontinued items, extraordinary items, that gives you net income. So this was your income statement. Then the extension of the income statement was comprehensive income statement. So to this net income number, we added OCI, other comprehensive income, which gave us C, or comprehensive income. So that was on tide, no C. So we looked at the income statement in pretty much detail back in FAR 1. But when I showed you the balance sheet, I told you we'll be covering it as we move on with our subject. So in FAR 2, we're going to focus on current assets and current liabilities. So we look at current assets and current liabilities. So by current assets, I mean assets that would be converted to cash within the next 1 year. Current liabilities, liabilities that would be settled within the next year. So in current assets, we're going to look at cash and cash equivalents. We're going to look at accounts receivable. So when you sell goods to customers on credit, that becomes accounts receivable. We're going to look at inventory. So that's the materials that you have in stock. It could be raw materials, work in progress, WIP, it could be finished goods. We'll also look at prepaid expenses. Rather, we've looked at prepaids back in FAR 1. So if I have paid expenses for the next year and this year, that's a prepaid expenses. In current liability, we're going to focus on accounts payable. We'll also look at certain expenses payable. So something like income tax incurred during the year have not been paid, income tax payable. Rent for this year not yet being paid, rent payable. So these are all expenses payable. So an expense payable is a current liability. An expense paid in advance, that's a current asset. So we saw that in accruals and deferrals in FAR 1. And we'll also have short-term debt as current liabilities, but we'll talk about that later. So if it's a long-term debt, that's a non-current liability. So as you can see, I've put in current and non-current assets, current and non-current liabilities. Now in FAR 2, as I told you, we'll be focusing on the current assets and current liabilities. When we get to FAR 3, that's when we look at investments. Now investments could be current or non-current assets. And we'll also talk in detail about PP&E, which is property, plant and equipment. That's a non-current asset. We'll look at intangible assets, something like patents, trademarks, goodwill. So that's all coming in FAR 3. And then when you come back again for FAR 4, that's when we'll talk about non-current liabilities. We'll look at bonds payable, that's a non-current liability. We'll also talk about leases and pensions, so that will be liabilities as well as assets. And then in FAR 5, we'll look at stockholders' equity. So as you can understand, we will be studying about the components of balance sheet as we move on. So we'll study it in FAR 2, 3, 4 and 5. And by the time you're done with FAR 5, you'll know how to master this balance sheet as you mastered the income statement right in FAR 1. So let's start talking about our current assets and liabilities. Now, current assets less current liabilities, that becomes your working capital. Let me put it here. Working capital is equal to current assets minus current liabilities. Then you have something what we call current ratio. This is current assets by current liabilities. Let me put a few numbers on the balance sheet out here so that you actually understand these ratios. Let's have a few numbers out here. So for cash and cash equivalents, let's put a number of $30,000. Accounts receivable, let's put $150,000. Inventory, let's have it at 60. For prepaids, let's have a number 30. Accounts payable, let's call it another 30. Expense payable, we could have, let's say, 15. Short-term debt, we could have 90,000. So now let's sum it up. What's our total current assets? 180, 240 and 270. What's our current liabilities? 90 plus 30, 120 plus 15, 135. So guys, what's the working capital here? We got current assets of 270, current liabilities of 135. So working capital is $135,000. Now, when I'm looking at the current ratio, what's my current assets? 270. What's the current liabilities? 135. So the current ratio, that's 2. So you could say that the current assets are twice your current liabilities. That's your current ratio. Now we look at another ratio which we call quick ratio or the acid test ratio. So we look at quick ratio. When you're doing quick ratio, your denominator remains as current liabilities, but your numerators, that's cash plus marketable securities plus accounts receivable. Something like when you're looking at current assets, they are convertible to cash within the next 1 year. When I'm looking at quick ratio, I'm looking at those current assets which are very easily convertible to cash. Now cash, that's cash and cash equivalents, that's literally very liquid, that's immediately convertible. Marketable securities, I can sell them the next day. So marketable securities and accounts receivable, that's also pretty easily collectible. But when I'm looking at inventory, we will first have to sell the inventory, then collect the cash. 2 steps here. Accounts receivable, just go and realize the cash. So in asset test, in quick ratio, we are looking at current assets which are more liquid. So we are not looking at inventory here, because for inventory, I'll first have to sell the goods, then collect the cash. We're not looking at prepaid expenses, because think about it, I have paid my rent in advance. Can I go to my landlord and take it back? Certainly not. So not so easily convertible to cash. I'm looking at assets very easily convertible. So you could say in the quick ratio, your numerator is current assets minus inventory minus prepaids. So let's look at it. So cash here is 30, receivables is 150. We don't have marketable securities out here. That's fine. We'll look at it when we get to part 3. So let's say this is 30, this is 150. So the numerator here is 180. Denominator remains the same, 135. So this becomes like 1.33. So if you look at it, current ratio is higher naturally because you've more on the numerator here. You also have inventory and prepaids. But when you're looking at quick ratio, you don't have inventory, you don't have prepaids. So it's 270 minus 90, 180. Denominator remains the same, current liabilities becomes 1.33. So these ratios are often called solvency ratios. So if you want to check whether the business has enough cash to pay its debts as they come due, current liabilities, they are going to become due in the next 1 year. Does the business have enough cash or will be able to generate enough cash to pay these liabilities as they come due? So these are solvency ratios. Now the next set of ratios that we're going to look at is activity ratio. How active is the business? Does it jog? Does it exercise? Does it run? So you have activity ratios. And here we're going to look at inventory turnover, receivable turnover, payable turnover. So inventory turnover, we're talking about how active the business is with its inventory. How soon is it able to turn over its inventory? So buy goods, sell goods, buy goods, sell goods. How fast can it do it? That's inventory turnover. We'll also look at receivables turnover. So sell goods, go and collect the cash. Sell goods, go and collect the cash. How fast? How many times does it do that? Sell goods, collect the cash. That's receivables turnover. And we'll also talk about payables turnover. You want these two to be very fast. So buy the goods, sell the goods, buy the goods, sell the goods. Very fast. Sell the goods, collect the cash. Sell the goods, collect the cash. This one, you want a little slower. So buy goods from your vendors, pay them the cash. Buy goods from your vendors, pay them the cash. You want this to be a little slower than the rest, right? You want to keep the cash with you, pay them a little later. But then not too slow, because if you don't pay them on time, that hits your credit worthiness. So payables turnover. So we look at all these three turnover ratios. So when I'm talking about inventory turnover, now guys, whenever you have a ratio which uses the term turnover, remember to turn it over. So turnover means you turn it over. So when I'm looking at this ratio, the denominator would have inventory. Because it's inventory turnover, the denominator is inventory. When I'm looking at receivables turnover, what's the denominator? Receivables, exactly. When I'm looking at payables turnover, everybody knows it. Payables is your denominator. We're looking at average inventory. We're looking at average receivables and average payables. Average means beginning inventory plus ending inventory by 2. Beginning receivables plus ending receivables by 2. Beginning payables plus ending payables by 2. Then on the numerator, so inventory relates to what? Your cost of goods sold. So the inventory number here relates to the cost of goods sold. So that's your numerator here. So it's COGS by inventory. And you remember that inventory is the denominator here. Why? Because it's the inventory turnover. So you turn over inventory. Receivables turnover. So you turn over your accounts receivable. And your numerator here is sales. Inventory relates to COGS. Receivables, they relate to your sales. And we're looking at net credit sales. So sales less any discounts, less any returns. And we're looking at credit sales, because if you're selling in cash, you don't have receivables, you directly get cash. So you're looking at net credit sales out here. Net credit sales. Payables turnover, so you're looking at average accounts payable, and payables relate to your purchases. So we're looking at net credit purchases here. We'll talk about the inventory turnover, receivable turnover, payable turnover. Let's use the numbers. Yeah, that'll be better. Now, as I told you, we're looking at COGS by average inventory. So let me put numbers on your income statement as well. So let us say we'll have 900,000. We have 900,000 of sales during the year, and the cost of goods sold was 720. Gross margin 180. And we're looking at average inventory, average receivables, average payables. So looking at beginning and the end of the year numbers. To make this very simple, let's assume that the beginning of the year numbers were the same as end of the year numbers. That'll make it easy for us. So we'll have 150 as the beginning and the ending number, 60 as the beginning and ending number. Now, in reality, these won't be the same numbers, but to make it simple, we're using the same numbers. Payables, let's say beginning of the year it was 30, end of the year again it's 30. So the business is doing the same quantum of work basically. When I'm looking at COGS by average inventory, so what's my COGS here? 720. What's the average inventory? Average inventory is 60 plus 60 by 2. That's 60. 720 by 60, that gives me 12. So basically the business has turned over its inventory 12 times during the year. So the inventory turnover ratio is 12 times. So it's been 12 times during the year that they bought the inventory, sold the inventory, bought the inventory, sold the inventory. They did it 12 times during the year. Now let's look at receivables turnover. So let's say all the sales were in credit, so 900 of net credit sales, and you have average receivables of 150 plus 150 by 2. So that's 150. So that's by 150, that makes it 6. So basically the receivables turnover was 6 times. What you could say is it's been 6 times during the year that the business sold goods to customers on credit, went and collected the cash. Sold goods on credit, collected the cash. Sold goods on credit and collected the cash. So that is receivables turnover. Then when we're looking at payables turnover, we're looking at purchases. So because the inventory number remained the same, it was basically 720 of purchase during the year. So what is COGS? COGS is basically beginning inventory plus purchase minus ending inventory. So because the inventory numbers have remained the same, purchase is same as COGS. Now we'll talk about this when we're doing inventory in the later part of the day. So the net credit purchases here, let's say it's still 720, and you have payables 30 plus 30 by 2, that's again 30. So that's 24. So it's been 24 times during the year that the business bought goods from its vendors on credit and paid them. Bought goods, paid them. Bought goods, paid them. Pretty fast. Now, let us look at the cycle. We will look at the operating cycle and the cash conversion cycle. Let's see what's actually happening here. So let's get on that part of the board. So if I draw a line here, a timeline, an activity line, you could say at this point the business starts with receiving goods from its vendors. So buying goods from vendors. So receive inventory from vendors or suppliers. Then after it receives the inventory, it has got to pay its suppliers, right? So depending on the credit terms, it's got to pay cash to suppliers. So let's say at this point the business paid cash to its suppliers. Then naturally the business has received inventory. Why did it buy inventory? To sell it. So now the business sells inventory. Now once the inventory is sold on credit here, now you got, so at this point you recognize revenue because you've earned it and it's realizable. Remember, earned plus realized or realizable. So you've sold goods on credit, you've done your job, it's realizable. But the point is, when do you realize the cash? That's when your operating cycle completes. So you go to your customers, you collect cash from customers, sell inventory to customers, and at this point you collect cash from customers. So this is your operating cycle. This is when inventory comes into your company, and this is when you finally realized, collected the cash on this inventory after selling it. So let us look at the journal entries that we pass at each point. So at this point, when you receive inventory, receive goods from your suppliers, your journal entry is inventory, because inventory is the asset that's coming in. Inventory to accounts payable. Because you got inventory, that's what's coming in. Payables, it's due to your creditors, due to your suppliers. When you pay suppliers, that's when you clear off your payables, and what goes out? Cash. Now at this point, when you're selling inventory to your customers, so what's your journal entry for sale of inventory? When you're selling it, goods are going out, so it's sales, so accounts receivable debit and sales credit. Now at the same time, you pass another journal entry, and we'll talk about this in detail when you're doing inventory today. You pass another journal entry because when you've sold goods, your inventory has gone out, and that's also an expense. So you have COGS to inventory. So you have accounts receivable to sales and cost of goods sold to inventory, and this is passed immediately if you are following the perpetual method of inventory. Now as I'm telling you, we'll talk about inventory in the later half today. Now, so this is receive inventory from suppliers on credit, paid them the cash, sold our goods, sold the inventory that we received, and now after some time, after the credit period that we are giving to our customers, we're going to go to our customers, collect the cash from them. So that would be basically accounts receivable was a debit here, now it'll be a credit because now it's no longer receivable, we've collected the cash. What came in? Cash. So these are the journal entries that you would basically pass as part of all these activities that you do as a business. Now, we will have a lot of conversion periods out here. So let us say we bought inventory at this point and we sold off inventory here. So this period here, we bought inventory here, we sold it off here. This is your inventory conversion period, ICP. At this point, you had your accounts receivable. They were born here because they were born when you sold goods to them on credit. and they closed out when you went to them and collected the cash. So this becomes receivable collection period. Now, let's look at payables. So you had payables which were generated here when you bought goods from your suppliers on credit, and at this point you paid them the cash. So this becomes your payables. Let me create a little more space out here. So this becomes your payables deferral period. So when I'm looking at inventory conversion period, a simple way of calculating this formula would be 1 by, or rather 360 by inventory turnover. Or you could, we'll just develop the other formula later. So let's call it this one, receivables collection or receivables conversion period, as 360 by receivable turnover. And payables deferral, we will call it 360 by payable turnover. If I'm looking at my inventory conversion period using the numbers that we have generated here, so inventory turnover, that was 12. So if I do 360 by 12, that gives me 30 days. So it takes me 30 days from the point I buy the inventory for me to sell the inventory. Guys, do you understand? Because it took me 30 days to do it once. So it takes me 30 days to buy the inventory, from the time I buy the inventory for me to sell it. So it took me 30 days. That is the reason why I could turn over my inventory 12 times during the year. 30 days, I did it once. How many times would I do it in 360 days? 12 times. Same logic applies here. So receivables collection or conversion period, 360 by 6. That gives me 60 days. So you could say it takes me 60 days from the time I sell goods to my customers for me to go out and collect the cash. So it takes me 60 days to do it once. How many times will I be able to do it across the year? How many times will I be able to turn over my receivables? 6 times. So this is, you could say, 360 by receivables turnover. When I'm looking at my payables turnover, again 360 by 24. 24 is the payables turnover. So the payable deferral period is basically 360 by 24, which gives me 15 days. So it takes me 15 days from the time I receive goods from my suppliers to pay my suppliers. 15 days for doing it once. How many times across the year? 24 times. Assuming that the year has got 360 days. I know you know it 365, but for calculation we're taking it as 360 out here. Makes it easier. Now, another way of calculating these conversions or deferral periods is doing, so if I'm looking at this 360 by inventory turnover, I could simply turn it over. I could also say that the inventory conversion period is basically average inventory by COGS per day. I mean, if you realize, this is a reverse. So this is 360 by inventory turnover. So I'm just reversing. I'm taking average inventory as the numerator now and COGS as the denominator. So I'm doing COGS by 360 or COGS per day. So COGS per day. COGS by 360. In this case, we could do average accounts receivable by credit sales, net credit sales per day. So you could say sales per day or credit sales per day. Net credit sales per day. This would be average accounts payable. So the denominator here becomes the numerator, average accounts payable by purchases per day. Now you might not, it's not required for you to remember the second part, because if you know the first part, you can always calculate the turnover ratios and then calculate the period. But we'll still do this. So what's average inventory out here? Average inventory is 60 and COGS per day. So we had 720,000 of COGS for 360 days. Per day it's 2. 60 by 2, that's again 30 days. Average receivable. So what's the average receivables? 150. What's your sales per day? Across the year you sold 900. Per day you could say you sold 2.5. So that makes it again 60 days. Average payables, that's 30, and purchases per day 720. So every day you bought 2000 worth of goods. Again, your payables deferral period is 15 days. So the result comes out to be same. I prefer this first formula because you can easily calculate your turnover ratio and then calculate the period. Now guys, as you can understand, so we're talking about inventory conversion, receivables conversion, and then payable deferral. Now the operating cycle that your business has, so the inventory conversion, this was 30 days, payables deferral was 15 days. Let's put the days here. So this period, this time period, this is, let me use the red pen here, this is 15 days from the time you receive inventory to the time you pay your suppliers. Inventory conversion, that's 30 days. So this is 15 plus another 15 days here. Receivables collection, that takes 60 days. So you could say that the operating cycle of the business is 15 plus 15 plus 60. That makes it like 30 plus 60, 90 days operating cycle. How about, so that's the operating cycle from the time goods come in till the time that's converted or realized into cash. What's the cash conversion cycle of the business? Now we'll talk about cash conversion cycle when we're looking at working capital management in BEC, but I'll just give you a heads up now. So cash conversion, guys, this is the point when inventory came into the company. What was the point when cash actually went out? Cash went out here. If I put a box on this, cash goes out here and cash comes in here. So this is the point where cash went out. This is the point when cash comes in. So what's the cash conversion period? So I could say 15 plus 15 plus 60, that was 90 days of operating cycle, minus 15 here. So this part is my cash conversion cycle. So that is not 90 days, it's 75 days. You could say the cash conversion cycle is the inventory conversion period, that's 30 plus receivables conversion period 60, 90 minus payables deferral period minus 15. So 30 plus 60, 90 minus 15, 75. So it takes us 75 days from the time we give out cash to collect back the cash. So that's the cash conversion cycle, more relevant from a working capital management perspective in BEC. For financial accounting and reporting, you could say the operating cycle is 15 plus 15 plus 60. This is 90 days. So this is the operating cycle. This is the cash conversion cycle. So now we're looking at the operating cycle of 90 days. So when I told you current assets, so I said current assets are assets which are convertible to cash within 1 year. Now the actual definition is current assets are convertible to cash within 1 year or the operating cycle, whichever is longer. Guys, understand the operating cycle, we have it as 90 days out here. Generally, you will have operating cycles of less than 1 year, right? So the current assets is 1 year, convertible to cash within 1 year. So once again, convertible to cash within 1 year or the operating cycle, whichever is longer. 1 year is generally longer, so it's convertible to cash within 1 year. For current liabilities, those are liabilities which would be settled in cash within 1 year or the operating cycle, whichever is longer. What is longer? The operating cycle of 90 days or 1 year? 1 year is generally longer. So that would be basically settled in cash within 1 year. There might be some businesses which have operating cycles. So this business had 90 days, more than 1 year. Very few businesses, let's say heavy electricals, people selling PP&E, for them they might have operating cycles for more than 1 year. For them, current assets are assets which are convertible to cash within that longer operating cycle. Liabilities are settled in cash within that longer operating cycle. So guys, right now we've started with working capital, current assets and current liabilities. I've given you your current ratio, your quick ratio. I've talked about activity. How fast do you run? How fast does your business run? How much time does it take for you from the time you buy inventory to pay your suppliers, from the time you buy the inventory to sell the inventory, from the time you sell the inventory to collect the cash? Let's look at all this on the book. On page 2 of FAR 2, we're looking at current assets and current liabilities. Highlight current assets. So these are assets that will be used up or converted to cash, highlight within 1 year or the operating cycle, whichever is longer. So under current assets, we're looking at cash and cash equivalents, looking at trading securities, accounts receivable, notes receivable, inventory, prepaid expenses, short-term investments, cash surrender value of life insurance. We'll talk about that. Next, highlight current liabilities. So these are liabilities that will be settled, highlight within 1 year or the operating cycle, whichever is longer. So here we're looking at accounts payable, notes payable. We look at accrued expenses and liabilities, dividends payable, payroll expenses due, property taxes due, advances that you've received from customers. And the last one, highlight short-term debt and current portion of long-term debt. On the next line, put a box around US GAAP. So under US GAAP, short-term obligation may be classified as non-current debt if there is an highlight intent and ability to refinance. Moving to page 3, we're first looking at working capital ratios. So solvency ratios, right? Solvency is equal to ability to pay debts as they come due. So when we're looking at the current ratio, we're looking at whether we have enough current assets to repay our current liabilities as they come due. Quick ratio, instead of looking at all the current assets, we only look at very liquid current assets. Then you have operational efficiency ratios. First, let's look at receivable turnover ratio. Your numerator here is highlight net credit sales. And for turnover ratios, we know we turn it over. So the denominator is going to be receivables. It's average net receivables. Circle net because you net your receivables for any allowance for uncollectibles. Next, we're looking at inventory turnover ratio. Numerator here is highlight COGS. Denominator, you turn it over. So in this case, the denominator is average inventory. Now on the second part of this page, let's look at the cash conversion cycle. So you have a timeline there where it starts with receiving materials from suppliers. So the journal entry in that case would be debit inventory and credit accounts payable. You can write A/P. Then you pay your suppliers. So write debit A/P accounts payable and credit cash. And I want you to circle cash here because our focus is looking at the cash conversion cycle. So at this point, cash is going out. Then you sell the finished goods. The journal entry here is debit A/R or accounts receivable and credit to sales. And then you go out and collect cash from receivables. So write cash debit and accounts receivable credit and circle cash. So cash went out when you paid your suppliers and cash came in when you collected your receivables. So the cash conversion cycle is the difference in the timing between the payment to suppliers and collection from receivables. CCC, so right there, is equal to cash to cash. And this is also equal to ICP, that's your inventory conversion period, plus RCP, that's your receivables collection period, minus PDP, that's your payables deferral period. Turn to page 4. So here you have inventory conversion period. Highlight ICP and that's equal to highlight 365 divided by inventory turnover ratio. Next you have receivables collection period. So highlight RCP and that's equal to highlight 365 divided by receivables turnover ratio.